Hello and welcome. You're watching this earnings special conversation on Business Today Television. I'm Sakshi Batra, and this edition we will focus on HDFC Life's Q1 numbers that have come in. HDFC Life Insurance has reported a 14.4% surge in its net profit in Q1 of FY26. The net profit is now stands at 547 odd crore rupees. Now we are also given to understand that the insurer's total annualized premium equivalent, that's APE, now has come in at 3,225 crore rupees. That's higher than the street estimates. However, when we talk about the value of new businesses, that was just slightly lower than the estimates of the street of around 815 crores. It's come in at 809 odd crore rupees. Now, the company's also gained market share during the quarter, and that's encouraging as well. The overall market share has risen by 70 basis points to 12%. It's also gained 40 basis points in the private sector as well, taking its share to 17.5%. There are other parameters that we'll also be discussing with the management. Ms. Vibha Padalkar, who is the MD and the CEO of HDFC Life, is now joining in on the program to detail for us what has gone into this strong set of numbers that have been reported. Good morning, ma'am, and thank you so much for taking the time out for this conversation. Well, congratulations. A steady and strong set of numbers that have come in as the start of this financial year as well. It's an all-round performance that we are seeing. Could you detail for us any key factors that truly contributed to this growth?
Yes, a few things, and we are fairly pleased because if you remember, last year first quarter grew by 31%. So it was a tall ask. And so on a 2-year CAGR basis, growth has been 21.5%. So reasonably pleased. Also on the back of that growth, like you mentioned, market share expansion of 70 basis points at an overall sectoral level to reach, for the first time in the history of our company, to reach a percentage of 12.1% market share. And on a private on the private companies as well, we had a 40 basis points increase to end at 17.5%. Now, all our channels as well as our segments have done reasonably well. If you were to look at segments first, we launched participating products both in terms of the savings and pension. That was received exceedingly well, and we grew more than 100%. So we doubled in the first quarter. Protection grew by 19%. Annuity also did fairly well, which is a non-par segment. It grew by 25%, and so on. So it was Credit Life saw a comeback. As you know, last year was a bit of a dampener on Credit Life because of the overall lending environment. So at least the non-MFI segment has bounced back into growth that is higher than company level growth. And hopefully MFI segment will also over the next few quarters start seeing green shoots. So that is as far as the segments are concerned. On if you see the distribution parts of our business are concerned, bank assurance grew faster than a company level growth. Also our direct channels and online channels did well. Agency channel was a little bit tepid, although what anecdotally we believe that our market share has gone up. But I think overall, in terms of individual agents, possibly there has been some level of sluggishness. Hopefully, as agent build-up happens in all companies, that should bounce back over the next few quarters.
Okay. Help me understand a little bit on the net premium income, ma'am. It's grown by 15.6%. Is this a number that you were happy with? Can it improve even further from here? What is your expectation for the following year?
Yeah, I think it's considering the base effect, this is a very good number. And also surrenders have been very range bound. We've done fairly well. So as a result of which, even when you triangulate that with assets under management, that has grown by 15%. And that is not possible unless both the premium income that we receive and the surrenders and other exits that happen remains within our assumptions or our expectations. And happy to share that holistically, all aspects of our business have remained in the 12 to 15% range.
Okay. Ma'am, value of new business, let's discuss a little bit. The margins here stand at 25.1%. So what is the outlook for the remaining fiscal year that we have? And what will you end the year with on this one, ma'am?
So I want to elucidate a little bit on the margins. So optically, it looks like 25% has gone up marginally to 25.1%. But in real terms, if you were to look at the impact of surrender charges, and this is there, the waterfall is there in our investor presentation on our website. if you were to look at the waterfall, you will see that the 25% actually went down to 24.7% because of the 0.3% impact of surrender charges. So actually, we have clawed our way up from
Okay.
24.3% 25.1%. So there has been a 40 basis points improvement in our margins already in first quarter itself. So that's something I just to clarify.
Okay.
In terms of overall margin numbers, we are hopeful that the 30 basis point negative impact, like we have made good in the first quarter, we continue to make good in the rest of the year and
Okay.
end at the range bound kind of margins. While
Range bound.
growth in both APE and in VNB.
Okay. So APE also, which is a metric of the sales growth, that's risen by 12.5% this year. Like you pointed out, this translates into a 2-year CAGR of over 21% odd, and this is nearly double of the industry. So can we expect you to grow at the same pace? Is there further scope for improvement from here as well, ma'am?
Yes, we will continue to aspire to grow faster than the industry and hence increase in market share. At the same time, growth will not be at the expense of growth in value of new business, and we will triangulate both these aspects very, very carefully.
Okay. And when we compare the VNB vis-a-vis APE, ma'am, what is the kind of growth path do you see for both vis-a-vis each other? Do you expect VNB to probably do better than APE over the next couple of years as well?
I think over the next couple of years, hopefully, if the macro environment picks up or stabilizes, then I would expect for the sector and for us a little bit of margin uptick as well. So, which means that BNB should grow at a slightly faster clip than AP.
Okay.
However, this year still we are not out of the woods, and at least for another quarter or so, I do expect to see both the sluggishness and macro-led volatility on many fronts, including tariffs.
Right. Ma'am, I remember from the last couple of quarters, we were talking about how the industry slowdown has probably come in from the surrender rules that started at, in October. So where are we at in the recovery? Are we still going to face some more, slowdown on the industry level? What does that do to your first half growth of the current fiscal year, ma'am?
So I do believe that some channels possibly have been disproportionately impacted. For example, and this is only a anecdotal feel of our agency channel because you're talking about individual agents and the impact that both as a manufacturer and as a distributor both are impacted due to surrender charges without necessarily this being the right objective for the customers. Some of the other channels like bank assurance do tend to sell more unit link products. As some of the banks do sell as high as 45 to 50% unit link products that does not get impacted by surrender charges. And so that's a story. There are very stark stories in terms of which distribution channels. Um, but I am hopeful that this bounces back as we come up with new product constructs, innovation, and so on.
Right.
But right now in quarter one, some of that has played out.
Okay. Ma'am, we've seen improvement in the long-term policy holder retention that's slightly offset by a slight dip in the early renewals. How is the trend there shaping up, ma'am?
Yeah, so very happy to share that our overall renewal premium has grown by a healthier than even normal of 19% improvement. Also, in terms of the slight dip in persistency, this is a story of two halves, wherein on unit link persistency, we have improved meaningfully over the last 2 years. Also, in terms of the slight dip on traditional products, I see that if you look at it sequentially, the dip has not been very material. Also, in the first quarter, it takes a little bit longer to collect premiums, and that has just been exacerbated because of the sluggishness in earnings and in savings and so on. So we are reasonably confident of making inroads to be able to collect more from customers whose policy premiums were due during the quarter one of this year.
Okay. Ma'am, could you also help us understand a little bit on the 13th month persistency ratio that measures how many customers renewed their policies in the first year? That has slightly slipped from 87.3 odd percent to 82.7%, whereas there has been a steady one on 45th and 61 growth as well that we have seen.
Yeah, in fact, we have done exceptionally well on the 61st month persistency,
Yeah.
which has actually improved by 800 basis points. If you were to talk about the 13 month, the correct number to see is not just for the quarter, because that gives you somewhat of a misleading uh, outcome in terms of only in that quarter what did you collect. But if you look
Okay.
at a 13th month into that quarter, then if you were to look at the current year, that is at 86%. And if you look at March, it is 87%. So it's only 100 basis points a decrease in persistency, which we will make up for as we connect with customers and cajole them to pay their premium. So it's just been 100 basis points fall rather than optically what looks like a 400 basis points fall for a standalone quarter.
Fair point. Two more points that I want to discuss. One is on the product mix, ma'am, that you were also highlighting a little bit. Could you help us understand? You've been looking at the traditional products, particularly the par policies as well. What is exactly your outlook, ma'am, going forward from here?
So I think one aspect that we timed it very well is that power products tend to do very well when there is a fair bit of volatility. And why is that so? Because it gives customers an upside because it underlying funds could have say 20-25% or thereabouts of equity. At the same time, you will not lose your shirt in terms of completely losing your money because of the market volatility. They don't tend to do very well when equity markets are doing exceptionally well and there is no volatile aspect in the equity market. That's when either unit linked products do well or non products do well or a combination. Par does well in this kind of a situation. We anticipated some of this volatility and timed launch of a particular product that has been received exceptionally well. We also relaunched our pension product that also is getting picked up very well. So I think this is the right place at the right time and a right solution. I think that's the culmination for our success in being able to successfully launch the power proposition.
Okay. Ma'am, on market share, which you did point out has improved even, as a first for you as well in some aspect. How would you expect that to pan out? Do you still see a lot of room for yourself to grow?
So we don't particularly target a market share because that is not that difficult and sometimes leads to practices that management team should not be following. However, we keep things simple and look at how we can grow faster than the private sector. I think that's what we will continue to do.
Okay. All right.
In
Well,
sorry, in the past quarters, you have seen an increase in market share. Last point is top line in a phase of 4.5 years. That too is something that we have delivered very successfully.
okay. Well, on that note, thank you so much, ma'am, for speaking to us on Business Today, for detailing your earnings. I wish you all the very best for a strong performance and a continuation of growth going forward in the current fiscal year. I wish you all the best. Thank you so much, ma'am.
Thank you so much.
All right, viewers, there you have it. HDFC Live detailing for us, the key factors behind the growth. On the industry level, there could be continued slowdown for at least some more time to go, at least in the first half of the current financial year. And only thereafter there could be some pickup. What Vibha ma'am also highlighted is that they are confident of growing higher than the industry and to continue to remain at this pace, and they are cognizant of all the the factors that are pushing their market share also higher, but they are also conscious of continuing to have the best practices that should not just come in at the cost of market share as well. I hope this has given you enough clarity as to how the company is really looking at the earnings and what is the growth outlook for FY26. Stay tuned with us on Business Today Television. We'll continue to get you such interesting earnings conversations with top companies and top managements as well on our channel. And of course, daily calls comes in at 12 noon. Stay tuned.
If you like the video, do like, comment, share and subscribe.